In part 1, keywords to remember were control, at a point in time or over time, and 5-step model. Control means a vendor will recognize revenue when control of the goods and services has been transferred to the customer. At a point in time or over time means revenue is recognized either at a point in time or over a period of time. And 5-step model is a principle and guidelines laid down by IFRS15 or US GAAP Topic 606, which you must apply to determine when and how to recognize revenue. In the 5-step model, in step 1, we identify the contract. In step 2, we determine the performance obligations. In step 3, we determine the transaction price. In step 4, we allocate the transaction price to each performance obligation. And finally, in step 5, we recognize revenue, which can be either at a point in time or over a period of time, depending on how performance obligations are satisfied. We are done with quick recap of part 1. Let's dive into part 2 now. In this session, we will cover following topics. What is contract? When will you need to combine contracts? What is contract modification and how to deal with this? And finally, we will look at a few examples to get an idea of how these principles and guidelines translate into practice. Contract creates rights and obligation for each party in the contract, which can be enforced in case one of the party fails to deliver his promise. In a contract, vendor agrees to deliver goods and services to the customer, and this is called performance obligation. And customer agrees to pay consideration to the vendor for the performance of the performance obligations, and this is called transaction price. And by virtue of contract, enforceable rights and obligations for each party is created. In a nutshell, contract equals performance obligation plus transaction price plus enforceable rights and obligation. For a contract to exist, this must satisfy following 5 criteria. A contract must be approved. A contract can be approved either in writing or orally or in accordance with business practices. Usually, contracts are approved in writing. Rights and obligations are identified. Payment terms are identified. Contract must have commercial substance. In assessing whether a contract has commercial substance, it is important to assess any termination provisions, specifically if either party to the contract has a unilateral enforceable right to terminate a wholly unperformed contract without compensating the other party, then in such a case, contract does not exist at all. Consideration agreed in the contract will be collected. Here, you only need to consider customers' ability and intention to pay amounts when they become due. It may happen that customers' ability to pay consideration deteriorates significantly such that customer no longer has the ability to pay when amounts become due. In such a case, revenue and receivables will be recorded up to the point at which deterioration occurred in the customer ability to pay, and no revenue will be recognized thereafter. We will elaborate more on this in part 6 of this video series, where we will be covering revenue recognition in detail. Two or more contracts entered into with the same customer or related parties may have to be combined into a single contract for accounting purposes. In case two or more contracts with same customer or related party satisfies one of the following criteria, then these contracts may have to be combined into a single contract. Contracts are negotiated as a single package with a single commercial objective. Amount of consideration in one of the contract depends on the price and performance of the other contract, that is, price and performance are interdependent. Goods or services that are promised in the contract or some of the goods or services represent a single performance obligation. In these cases, a careful analysis will be required to ensure that all related parties of the customers are considered. I'll repeat this. A careful analysis will be required to ensure that all related parties of the customer are considered. Contract modification is quite common. Contract modification will change either scope and or price of the contract. This is usually called change request or a change order and is approved in writing. Contract modifications are usually treated as adjustment to the existing contract. However, it is possible that a contract modification may give rise to an altogether separate contract. A contract modification is accounted for as a separate and additional contract only if addition of the promised goods or services are distinct and resulting change in price is the same as the standalone selling price of the additional goods and services at the date of contract modification. Again, careful consideration will be needed when determining appropriate accounting approach in circumstances in which contract is modified. Let us consider a few examples. On January 1, 20X1, you signed a contract with ABC Company to sell 500 units of laptop at $1,000 each. You will supply 100 units each month over the next 5 months. On April 1, 20X1, ABC Company asked you to supply another 100 units along with the April delivery. You agree to supply 100 units at the price of $1,200 per unit. On April 1, 20X1, standalone selling price of the laptop is $1,200. Since in this case additional laptops agreed to be supplied are distinct and price agreed is the standalone selling price of the laptop on the contract modification date. Therefore, agreement to supply additional 100 units of the laptop will be treated as a separate contract altogether. Net accounting result of this contract modification is revenue for laptops to be delivered under original contract will be recorded at $1,000 per unit, and revenue for additional 100 units agreed to be supplied on April 1, 20X1 will be recorded at $1,200 per unit under a separate contract. Let us take one more example. On January 1, 20X1, you sign a contract with ABC Company to sell 500 units of laptop at $1,000 each. You will supply 100 units each month over the next 5 months. On April 1, 20X1, ABC Company asked you to supply another 100 units along with April delivery. You agree to supply 100 units at $800 per unit and also agree to supply remaining 200 units of April and May supply under original contract at $875 per unit. On April 1, 20X1, the standalone selling price of the laptop is $1,200. In this case, additional laptops agreed to be supplied though are distinct. However, price agreed is not a standalone selling price of the laptop on the contract modification date, and therefore original contract will stand terminated on April 1, 20X1, and 200 units to be supplied at $875 per unit and 100 units to be supplied at $800 per unit will be accounted for under a new contract. In effect, average selling price under the new contract will be $850 per unit. Here is the calculation. Net accounting result of this contract modification is revenue for all remaining 300 laptops to be delivered will be recorded at $850 per unit under a new contract. Final thoughts on contract? Contract or agreement is an extremely critical piece of document in the whole process of revenue recognition. Therefore, structuring contract in a form and language that works for you for now and in the future is of utmost importance, and you must give good amount of thinking while agreeing contract terms. This can greatly simplify your life in terms of minimizing ambiguity when doing interpretations of the contract, and also to implement and maintain a proper and robust accounting policy. This is all for now. In the next video of this series, we will talk about step 2 of the 5-step model, that is identifying separate performance obligations. Thank you so much for watching and stay tuned. We'll see you soon in the next video. Thank you.